Are you an experienced nurse that's been working in the medical field for quite some time and you're over all the crazy hours dealing with the doctors and the patients and you're just over all the stress of the job? Or are you new to the field and you see all the stress of the job and you already know you don't want to be a nurse for the next 30 years? Well, this video course is for you. My name is Amanda Ryba. I have been working as a licensed financial coach and consultant for the past 8 years as the date this video was produced. And it is my goal to illuminate to the world what wealthy people know and understand about money. And one thing all wealthy people understand when it comes to money is you need to save it in ways where it's accessible to you in the future at any time, at any age, without paying any penalty. Today, we're going to talk about it. Today's course really is specifically designed for nurses to teach them how to retire at any age they want. So, whether you're brand new to the medical field or you've been in it for quite some time, by the time you complete today's course, you will have all the tools you need to get started. Now grab a notebook and a pen and let's dive in. I'm going to take you through 4 simple steps to get a better handle on your finances. Step 1, you have to create a budget. You have to get a basic list together of all of your monthly expenses, which could include rent or mortgage, your car payment, your car insurance, gas or tolls you pay driving, your food, your eating out, your going out, your shopping, any miscellaneous things that you do, travel. You got to get a basic list of all these items together. Then what you want to do is calculate out your discretionary income, which is essentially how much money you have left over after you've paid all of your basic living expenses. So how you calculate this is you're going to take your net income, which is the income that actually hits your bank account because taxes have been removed, subtracting out those monthly expenses that you just added up. That's going to equal your discretionary income. Now, if you want my personal budgeting worksheet that I use, all you have to do is comment below the word budget and I will message you the link to get it. And this will be very helpful to you in steps 2 through 4. Step 2, you're going to want to get a handle on your current financial portfolio. So you're going to want to list out all of your accounts. That is ultimately going to tell you what type of account you have. Do you have a retirement account? Do you have an investment account? Do you have a life insurance account? Do you have an annuity? That will tell you how liquid, how easily accessible that money is to you, and ultimately how that account type gets taxed. Then from there, you want to find out in a dollar amount how much you are contributing into this account per month or per year. You can usually find that out by checking an account statement or by simply looking at a pay stub if it's a traditional retirement account. Then from there, you also want to know the current balance of the account. So you can find this out by logging into your account online or by also checking a recent account statement. Step 3, you need to list out all of your debts, anyone or anything that you currently owe money to or that you're working to pay back. First, you need to list out what type of account it is. Is it a mortgage, a credit card, a student loan, a car payment? From there, you need to list out the total amount that you owe and what you are currently trying to pay monthly on it to get it paid off. And bonus, if you know the interest rate that you're being charged. And the 4th step is the fun one. You get to list out all of your goals, all of your short-term, mid-term, long-term goals. Short-term is 0 to 2 years, mid-term is 3 to 10 years, and long-term is anything 10 years plus. List out all of them, anything you can think of, whether that's making a big purchase, whether that is taking a big trip, whether that's getting married and having a family, whether that is making a big move, whether that is maybe buying a home, or possibly retiring early. You want to list out all of your goals and the desired timeline on when you want to achieve it by, and also the desired amount of money that you need to have saved to make that goal happen. Okay, that was a lot. So what I want to encourage you to do now is pause this video and go and complete steps 1 through 4 if you have not already done that. You are going to need that information before you proceed on through the rest of the training. So now is your time. Press pause. Okay, you're back. So now we have to dive into the accounts that you currently have to see if they're actually suitable to help you accomplish your goals. Let's start with your liquid accounts. Accounts such as bank accounts, high yield savings accounts, investment accounts, which could be mutual funds, ETFs, stocks, bonds, and crypto, and of course, cash value life insurance. All of these accounts that you see here are considered liquid, which just means that you have access to your money without penalty. Now keep in mind, the bank accounts and the investment accounts, any interest that you earn inside those accounts is going to be considered taxable income. Now, they all still make great accounts to have for any short-term or mid-term goals because ultimately you do have access to your money at any time or age without paying a penalty. Now, you also need to keep in mind your risk tolerance, which is how comfortable you are with losing money. The number one rule when it comes to investing is the closer you get to needing your money, the less risk you should be taking on it. So for example, let's say that you need your money in the next 1 to 2 years. Well, you shouldn't have it in a high risk investment like a growth mutual fund or stocks or crypto. It should be in something more conservative like a bond portfolio or potentially even just a high yield savings account. Most online banks today are paying at least 5% interest per year just on their high yield savings. And if you have no idea what I'm talking about, just simply Google high yield savings accounts and a bunch of options will pop up. Now, I lump cash value life insurance into the liquid category if and only if the account is properly structured and funded. In its simplest form, this is a permanent life insurance product that grows the cash value inside of it by the client overfunding the cost to own the policy. Now, there are 4 different kinds of permanent life insurance products that grow cash value inside of it. We're not going to dive into all of them, but if your goal is to grow a cash value, you want to check out IUL policies because their cash value grows mirroring a stock market index. So when the market goes up, your cash value is going to grow, just like it would in an investment account. But the insurance company insures your money against any risk. So when the market goes down, your account value is protected and you don't lose anything. These accounts are great for people that don't want to see the fluctuations like they would in the market in an investment account, and they can make fantastic accounts for mid to long-term goals because you can get access to that cash surrender value inside your insurance policy at any time, at any age, without paying any penalty, and it's accessible to you all tax-free through policy loans. Now, I've linked a video below to give you some more information on how these work. Now let's talk about those traditional retirement accounts. Accounts such as 401ks, 403bs, 401as, TSP, 457, IRA, pensions, and annuities. These accounts are not considered liquid. They're only accessible to you when you retire, which right now the government deems as age 59 and a half. Now, there is something called the age 55 rule, which means if you retire after you turn age 55, you do have access to your money in your employer-sponsored plans, which are your 401ks, 403bs, 401as, and TSP accounts, without paying that additional 10% federal penalty. But you would have to leave your money in those accounts in retirement to access it. And rule number 1 when it comes to retiring is always take your money with you because you never know what's going to happen to that employer. If that employer goes under or has financial issues, it's going to be very difficult for you to get to your money. Now, if you have a 457, you can actually access that account at any age of retirement. But if you have any of the others, you cannot access the money until after age 59 and a half years old or older. Now, you also need to consider taxes. If you see the word Roth in front of any of the IRC codes associated with your account, such as a Roth 401k or Roth 403b, you can know that the money growing inside that account has already been taxed. So when you go to take out money in retirement, what you see is what you keep because you've already paid your taxes. But if you do not see the word Roth in front of your account, that money is growing tax deferred, which means you have not paid taxes on that money yet. So when you get into retirement and you start to pull money out, you will owe taxes on everything that you were drawing out of that account. In addition to that, you have to follow the age 73 rule, which means that you must start taking money out after you pass age 73 if you're no longer working. If you don't, you will pay an additional 25% federal penalty on the money that you are supposed to touch. Now, the question is always, well, which way is better to pay taxes? Let me start by asking you a question. Do you think in the future taxes will go up or down? Let's talk about it. The U.S. debt has officially crossed over $35 trillion. You can see that yourself by going to usdebtclock.org. And with programs such as Social Security, Medicare, and Medicaid underfunded, how could taxes even have a shot at going down in the future? Now, some people believe they'll retire in a lower tax bracket because they think they'll need less income to live off of. But with inflation on the rise, and if all of the tax brackets go up, and now you're in retirement and you've lost all of your tax deductions, how could you possibly retire in a lower tax bracket? Are you planning to retire poor, or would you like to thrive in your retirement? I encourage all of my clients to do the math themselves and see what type of accounts are going to make the most sense. You can simply just Google MoneyChimp 401k calculator. There are 401k calculators, IRA calculators for you to plug in your personal information to see where you're going to end up in retirement. Now, you also need to consider the stock market. How comfortable are you with managing your own investment portfolio? Do you watch the stock market every single day? Or would you prefer to have your money inside of an account where you could just focus on saving and you know it's guaranteed to be there for you when you retire? All of the traditional investment accounts that we talked about earlier in this video all grow your money in the stock market. So if you're not comfortable with managing your own investment portfolio, those accounts may not be the best fit for you to use for retirement or to reach your goals. So if your goal is to retire early, let's say by age 50, you already know that you can't get to the money inside of your traditional retirement accounts until at the earliest age 55. So that means you're going to have to find other sources of income to bring in to float you until you can get access to your money. Now, if you truly do want to retire early, which I believe you do, you would not be watching this course, then it's very important that you start getting your money into accounts that are flexible, that allow you to access your money at any time, at any age, without any penalty, but still earn you really good interest. And if you believe there's a chance that taxes could go up in the future, which honestly I highly doubt they could ever go down, you also want your money in accounts where it is accessible to you in the future, all tax-free. Right now, the only account that exists that has the potential to earn really good interest and grows your money accessible to you in the future, all tax-free, is cash value life insurance, or what we call IULs. The great thing with these accounts is you can save as much money as you want into them per month or per year. You choose your cap. The more life insurance you get, the more money you can save into that account per month or per year. The downside is you got to get approved. The insurance companies are going to look into your age, your health history, and your criminal background. That is going to give you a risk class. The higher the risk class, the more expensive the product is to own, which means the more money you have to save into that account per year to reach your goals. But if you can get approved at a good health rating and it fits your budget, these make fantastic accounts for nurses to own whose goal is to retire early. So if you are interested to see if an IUL could be a good fit for you, I recommend that you connect with a licensed life and health agent in your resident state or country that is trained on how to structure these plans as supplemental retirement income. If you live in the United States, you're welcome to connect with me or my team. Not now, but at the end of this video, you will see a link below where you can click that, and that will take you directly to our calendar where you can schedule a complimentary client consultation with us. Now you might be thinking, what if I already have money saved in one of those traditional retirement accounts from a former employer and I'm over losing money and paying taxes? What are my options? Well, unfortunately, you can't just roll money out of a retirement account and into an account like an IUL, because an IUL is considered a life insurance policy. It's not considered a retirement account. You can only roll from retirement account to retirement account without paying taxes or penalties. But if that account is with a former employer, you might have the ability to roll it into a fixed indexed annuity. FIAs are fantastic accounts for people that already have money saved in retirement accounts and they're over losing money. They grow the exact same way your IUL does. It's linked to the stock market, but it has an automatic lock-in feature, so when the market goes negative, you don't lose any money. Now, you still cannot touch the money inside until age 59 and a half or older, and they're going to be taxed the way the original retirement account that you rolled into it will be taxed. However, at least you won't have to worry about losing any more money in the future, which is great. So FIAs can make fantastic tools to use for money that you already have saved. I have linked a video below if you'd like to learn a little bit more. And if this is something that you think might be a good fit for you, you're also welcome to use the link below to schedule a call with me or my team to see if this is something that we can help you get set up. Congratulations! You successfully completed the course that I designed specifically for nurses, teaching you how to retire early. By now, you should have a solid budget to work with. You should have a list of all of your goals. You should have a basic understanding of your current financial portfolio, as well as which accounts you need to discontinue putting money into and which ones you should consider starting up. You should literally have all the tools you need to make this happen. But I do recommend do your own research before you do anything with the information you learned in this video. This video is for educational purposes only and is not meant to be taken as investment or tax advice. After doing your own research, if you still have questions and you'd like to work with me or my team, you can click the link below to schedule a complimentary client consultation with us. Now, If you like this video and you want to see more videos just like it, I recommend you check out my entire YouTube channel. I do release a new video every single week. All you have to do is click that subscribe button and hit the bell to turn on notifications, and you'll be notified when my next video comes out. Please give us a thumbs up and drop a comment below. Let us know what you liked and learned, and share this video with anyone else you can think of that is a nurse that is looking to get control of their finances and retire early. My name is Amanda Ryba, signing off, and I'll see you on the next one.